Hundreds of billions vanished into thin air just months before. Goldman Sachs found itself at the heart of an unprecedented storm in 2008, a time when the global financial system teetered on the brink of collapse. The sheer scale of the downturn was staggering, with markets worldwide losing trillions of dollars in value as major institutions like Lehman Brothers imploded on September 15th of that year. This single event alone left more than 25,000 employees jobless overnight, sending shockwaves across Wall Street and beyond into the real economy. Meanwhile, an outrageous detail regarding a controversial bonus pool reportedly reaching nearly $11.6 billion, destined for the firm's top performers, emerged even as the broader economy was crumbling. This news sparked widespread public outrage across the nation. Many people questioned how a financial company could distribute such vast sums when its very existence appeared to be dependent on significant government assistance. The US government eventually stepped in with the Troubled Asset Relief Program, or TARP, injecting an enormous $700 billion into struggling banks, a move aimed at preventing total economic meltdown. Goldman Sachs itself received $10 billion from this program, which further fueled public discontent. Critics vehemently argued these massive bonuses incentivized excessive risk-taking within the banking sector, which had been a root cause of the entire crisis. The Dow Jones Industrial Average plummeted over 54% from its peak in October 2007 to its lowest point in March 2009, wiping out countless retirement savings and investment portfolios. Mortgage defaults soared, affecting millions of homeowners across the nation, pushing unemployment rates past 10.2% by late 2009. The housing market alone saw property values drop by an average of 30% in many regions, from 2006 levels. This period marked a significant turning point in regulatory discussions worldwide, leading to calls for greater accountability, stricter oversight, and fundamental changes in how large banks operated. The new era of banking sought to prevent a catastrophic repeat of such an event, emphasizing greater capital requirements and reduced speculative activities, aiming for long-term stability. The perception of trust in financial institutions eroded significantly during this time. The financial system felt like it was playing with everyone else's money. This single bonus controversy became a symbol of systemic failures and a desperate need for reform, influencing policies for over a decade. $11.6 billion ignited a public firestorm. Goldman Sachs found itself at the epicenter of furious national debate, a deeply critical moment when the global financial system teetered on the edge. The firm's controversial bonus pool, reportedly reaching nearly that massive sum of $11.6 billion, was destined for its top performers, even as the broader economy was rapidly crumbling. This staggering news sparked widespread outrage across this nation. Many people questioned how any financial company could distribute such vast amounts when its very existence appeared dependent on significant government assistance. The United States government eventually stepped in with the Troubled Asset Relief Program, or TARP, injecting an enormous $700 billion directly into struggling banks, a decisive move aimed at preventing total economic meltdown of huge scale. Goldman Sachs itself notably received $10 billion from this program, further fueling intense public discontent and criticism. Critics vehemently argued these massive bonuses directly incentivized excessive risk-taking behavior within the banking sector, which had been identified as a root cause of the devastating crisis. The Dow Jones Industrial Average plummeted over 54% from its previous peak in October 2007 to its lowest point in March 2009, effectively wiping out countless retirement savings and investment portfolios for millions of ordinary Americans. Mortgage defaults tragically soared, affecting millions of homeowners across the nation, pushing unemployment rates past 10.2%. By late 2009, a grim statistic. The housing market alone saw property values drop by an average of 30% in many regions, from 2006 levels, leaving homeowners with negative equity. This unprecedented period marked a significant turning point in regulatory discussions worldwide, leading to urgent calls for greater accountability, stricter oversight, and fundamental changes in how large banks operated businesses. The new era of banking sought to prevent a catastrophic repeat of such a devastating event, emphasizing greater capital requirements and reduced speculative activities, aiming for long-term stability across financial landscape. The perception of trust in financial institutions eroded significantly during this tumultuous time. The financial system felt like it was playing with everyone else's money without regard. This single bonus controversy became a symbol of systemic failures and an urgent need for comprehensive reform influencing financial policies for over a decade. The sheer scale of market losses included trillions of dollars in value, as major institutions like Lehman Brothers implode on September 15, 2008, leaving more than 25,000 employees jobless overnight, sending shockwaves across Wall Street and beyond into the very real economy, affecting countless families and communities. The $700 billion TARP program was a monumental effort to stabilize a system on the brink. The $10 billion allocated to Goldman Sachs specifically highlighted the complex interwoven nature of government intervention and private sector responsibility. It became a watershed moment for financial regulation, globally influencing future policies like Dodd-Frank, which aimed for more robust oversight. The 30% average drop in housing values represented billions in lost equity for American families. The 10.2% unemployment rate painted a stark picture of widespread economic hardship. The 54% decline in the Dow wiped out substantial wealth for investors large and small, creating a generation wary of market volatility. This period cemented a new understanding that systemic risk was not just a theoretical concept, but a tangible threat with real-world consequences impacting every household. The continuous debate about executive compensation and corporate responsibility intensified dramatically, post-2008 continuing to shape public discourse for many years, reflecting a profound shift in societal expectations towards financial giants. The financial industry was forced to reevaluate its practices, leading to more stringent stress tests and capital reserves ensuring banks could withstand future shocks without needing massive government bailouts. This entire episode remains a critical case study in economic history, demonstrating the precarious balance between free markets and necessary government intervention to safeguard a national and global economy. Trillions vanished overnight. The year 2008 fundamentally reshaped how the world viewed Goldman Sachs and the entire financial sector, leading directly into a completely new era of banking, focused on preventing another catastrophic meltdown. The unprecedented $700 billion Troubled Asset Relief Program, or TARP, was a direct response, yet it highlighted deep structural flaws needing repair. A monumental legislative overhaul came, with the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in July 2010, a document spanning over 2,300 pages. This act introduced sweeping changes, including the formation of the Financial Stability Oversight Council, tasked with monitoring systemic risks across the financial system, ensuring no single institution could again imperil the whole economy. Banks suddenly faced significantly higher capital requirements, meaning they had to hold much more money in reserve to absorb potential losses, thereby shielding taxpayers from future bailouts. These requirements increased Tier 1 capital ratios for the largest banks from an average of about 8% before the crisis to over 12% in subsequent years, a substantial jump in liquidity. Stress tests became a regular mandatory feature, forcing banks with assets exceeding $50 billion to prove they could withstand severe economic downturns, like a deep recession or a sudden market crash without collapsing. These annual exercises rigorously scrutinized banks' balance sheets and risk management practices in ways previously unimaginable. The Volcker Rule, named after former Federal Reserve Chairman Paul Volcker, aimed to limit proprietary trading by banks, preventing them from making risky investments with their own capital, to avoid conflicts of interest and reduce speculative activities that had greatly contributed to the housing bubble. This rule specifically targeted activities like certain hedging and derivatives trading, which were deemed problematic. Executive compensation also came under much closer scrutiny, with new provisions for clawbacks of bonuses if risky behavior led to financial losses. This directly answered the public outrage over the $11.6 billion bonus pools distributed during the height of the crisis. The notion of too big to fail was directly addressed, with resolution authority granted to regulators allowing for the orderly dismantling of failing financial institutions without relying on taxpayer money. This created a credible threat of failure for large banks, encouraging more responsible risk management. The Consumer Financial Protection Bureau, CFPB, was established to protect consumers in the financial marketplace, overseeing mortgages, credit cards, and other financial products, directly addressing some of the predatory lending practices that fueled the crisis. This agency gained significant power, over $1 trillion in consumer financial products. These reforms fundamentally altered the operational landscape, requiring banks to rethink their entire business models and risk appetite. The number of new regulations skyrocketed, with thousands of pages of new rules implemented across the industry. Public trust in financial institutions, which had plummeted to historic lows during 2008, began a slow and gradual rebuilding process, although suspicion remained high for many years. The era of loose regulation and unchecked risk-taking was intended to be over-replaced by a robust framework designed for long-term stability and greater transparency. The ultimate goal was to ensure a crisis of the magnitude of 2008, which led to a 54% drop in the Dow Jones, and 10.2% unemployment, would never be repeated. The financial world changed, forever forcing banks to be more accountable and resilient for the benefit of the global economy and many citizens. This transformative period reshaped finance completely.